Let's start with the basics. Why do interest rates even matter in real estate? If you're buying property with a mortgage, congrats. You're dealing with interest rates whether you like it or not. Your rate directly determines your monthly payment, cash flow, debt service coverage, return on investment, and indirectly it affects property values, market liquidity, cap rates, risk appetite. In other words, interest rates shape everything. The golden rule of real estate leverage. When interest rates are low, borrowing is cheap. Your payments are smaller. Cash flow is higher. You can offer more for a property and still profit. But when rates rise, everything flips. Debt becomes expensive. Buyers pull back, and cash flow can evaporate overnight. That's what we've seen play out across the 2022, 2023, and now into 2025. The 2025 environment. Where we are now. Here's the reality in 2025. The Fed has paused rate hikes, but we're still sitting at the highest mortgage rates in 20 plus years. Cap rates are adjusting, but they lag behind in sellers. Many are still stuck in 2021 price fantasies. This creates a unique kind of market, one where deals exist, but they require precision. Cash flow is harder to find. Underwriting needs to be stricter, and buyers must use strategy, not emotion. Why most people lose money in high-rate markets. High interest rates reveal who's a real investor and who was just lucky. Amateurs buy based on hope. Pros buy based on math. When rates rise, your margins shrink, refinancing gets harder, cash outplays disappear, and you're stuck with high debt costs unless you plan ahead. Most people overpay. They assume appreciation will bail them out. But in this market, appreciation is not a strategy. Cash flow is. How interest rates change your cash-on-cash return. Let's get technical for a second. Imagine this. Property price, $400,000. 20% down equals $80,000. Loan equals $320,000. At 3.5% interest, your mortgage payment is approximately $1,436 per month. At 7.5%, it jumps to approximately $2,237 per month. That's an $800 difference in monthly outflows. Same building, same rent, but your return drops by thousands per year. That's the real power of interest rates. They're not just a headline, they're your margin killer if you don't plan. The Fed, inflation, and real estate outlook 2025. Now let's talk about what might be ahead. Many experts predict gradual rate cuts starting late 2025 or mid-2026. Inflation moderating but staying above 2%. A slow return to 5 to 6% mortgage rates, not 3% again anytime soon. So what does this mean for you? It means the window for creative finance is wide open. Sellers with low-rate debt are sitting on gold. If you can structure deals with subject to seller finance or lease options, 2025 and 2026 could be your breakout years. How to win in a high-interest market. Here's how real estate pros are playing the game right now. Buying with long-term holds in mind, using adjustable rate mortgages only when backed by exit plans. Finding off-market deals where equity cushions the interest rate pain. Negotiating seller credits to buy down rates. Partnering with others to bring more capital to lower LTV. High rates don't mean don't buy, they mean buy better. Creative financing becomes king. If traditional lending is painful, creative deals become powerful. Here are some ways investors are adapting. Subject to deals. Take over a seller's low-interest loan, seller financing, where the seller becomes the bank. Wrap mortgages, where you pay the seller and they pay the bank. Lease options. Control property now, buy it later. These are game changers, especially while interest rates remain above 6%. Cap rates versus interest rates, the investor's balance. In real estate, cap rate is your unleveraged return. Interest rate is your cost of debt. When your cost of debt is higher than the cap rate, bad deal, walk away, or restructure. But when you can buy at a cap rate that exceeds the interest rate, especially in growing markets, you win. This is called positive leverage, and it's your wealth accelerator. The rent growth versus rate tightening tug of war. Rents are still growing in many metros, but slowly. In high-rate environments, landlords raise rent to stay cash flow positive. Tenants push back. Vacancy becomes a risk. Your job is to find markets with strong job growth, population inflow, limited housing supply, and rent-to-price ratios that still make sense. Those are your safe havens. What to avoid when rates are high? Avoid these mistakes. Buying negative cash flow, appreciation bets. Using adjustable rate loans without an exit plan. Overestimating rent growth. Underestimating operating costs. Assuming you can just refi later. The best time to refinance is when you don't need to. Plan for the worst. Hope for the best. Buy for cash flow. Refinancing strategy in a high-rate cycle. Yes, you can still refinance smart. Consider this. Buy now with a rate in the 6s or 7s. Lock in long-term fixed debt, underwrite conservatively. In 2025 or 2026, refinance down to 5% or lower. Now your cash flow explodes, but you were still profitable before. That's not speculation. That's strategic leverage. Commercial versus residential. Who gets hit hardest by rising rates? Commercial investors feel the pressure first. Why? They often use bridge debt or interest only. Valuations are tied to cap rate compression. Lenders require higher DSCR and lower LTV now. That's why we're seeing distress in office, retail, and even multifamily syndications. But residential investors with fixed-rate 30-year loans, they're weathering the storm much better if they bought right. Investor mindset in a volatile interest environment. Here's your mantra. Cash flow now. Appreciation later. Underwrite ugly. Hope it turns out pretty. Be liquid. Be patient. Be creative. The winners in 2025 and 2026 won't be the flashiest. They'll be the ones with systems, discipline, and long-term vision. Closing advice for real estate investors in 2025 to 2026. Real estate is still the #1 vehicle for building wealth. But the market conditions have changed. You can still grow, still profit, still build generational equity, but only if you adapt. Interest rates are not your enemy. They are the truth serum for bad deals and the filter that keeps amateurs on the sidelines. This is your moment. Do the math. Buy with strategy and build your portfolio the right way.